All right, well, a lot of commentary overnight, particularly from Michele Bullock, RBA Governor, with reference to the property market. Also got some latest data out too, just in terms of prices across the nation. Let's get into it. Anthony Landahl joining us from Equilibria Finance. Good to see you.
Good afternoon, nice to be here.
Yeah, interesting, because actually just ask you first about CoreLogic have come out with their latest data, talking about the V-shaped recovery.
Yeah.
That their national home value index reaching a new record high in November.
Yeah.
We're seeing that demand and supply dynamic playing out where simply we've got that shortfall, haven't we, that's really driving some of those prices.
Yeah, I think that chronic shortfall is starting to kick in. We've had the peak in April 2022 and we're essentially back at those levels as what's been identified. And it's not just driven by a couple of isolated areas. We're seeing the strong growth came back from January earlier this year, mainly driven by some of the major capitals, Sydney, Melbourne. Now we're seeing Brisbane, Perth, Adelaide. Even some of those regional areas that were probably overvalued throughout that COVID period are starting to grow again. It's not just the houses, it's coming through to units. So I think the other interesting aspect CoreLogic have looked at a little bit is the impact of the net migration growth, what impact that's having on the sort of supply side and the demand side, driving up prices on extra demand. They're not identifying any major trends there in terms of housing prices and rentals. What they're more identifying is this chronic shortage in supply, and also demand has essentially been keeping up to date. I say to date because there might be some indications that that rate of growth might start slowing into the new year. But so far, each of the majors have been trending back up, and we're back up to those record levels of April 2022.
Yeah, I mean, so Michele Bullock in a speech referenced what we're seeing there at the moment. You know, once again, talking about immigration, but also feeding into that broader demand picture at the moment, and that, as the consequence, seeing that flow through into the property sector. What are we seeing in regards to borrowing at the moment then, given interest rates have just been hiked this month, property prices continue to go up? Is there going to be a disincentive then for those borrowers?
Yeah, credit flows have definitely dropped off. We saw that particularly with investors. Credit flows, a lot of investors took a very cautious approach, sat on their hands. Cost to hold properties with the cost of funding was growing a lot quicker than, I guess, the rental yields, even with those tight vacancy rates. We've absolutely seen credit flows drop across construction, owner-occupier, first home buyers and investors. We are starting to see credit flows grow a little bit again. Refinancing's definitely come off a little bit from some heady days, I guess 6 months ago. Things have settled down, a lot of those fixed rates have come off, albeit there's probably another 300,000 or so fixed rates to come off next year. So there is a little bit of a talk about whether we're going to get a bit of a lag in terms of the full impact for mortgage holders. There were some savings buffers for people. Not all the fixed rates are off, but credit flows have been down. Access to credit is still there with the providers. The interest rate environment's still quite competitive, albeit we're obviously 4.25% above where we were back in April 2022.
Yeah, you talk about construction there. Of course, the government has that ambitious building plan to solve that supply crisis. And once again, the Reserve Bank Governor is referencing that too. I mean, how realistic is that to meet those targets at this point?
Well, I think Michele Bullock intimated pretty well that it's their ambitious targets that are unlikely to be met. I mean, the government was essentially looking at building 240,000 new dwellings through to 2029 per year. 2023, I think, was about 175,000 approvals. 2024 is about 150,000. So we've got this confluence of dwelling approval numbers are down to a 10-year low. We've got record migration coming in, which is exacerbating this shortage in supply. And there's no quick fix in terms of that shortage. Dwelling approvals are down because of zoning issues, because of difficulties with getting materials, construction costs, labour costs, and even the rent to build projects where we're getting foreign investment, where we're getting Australian investment, there's either a lag on them, or the government incentives probably have to make some changes around the tax incentives to get some of these projects built in reasonable timeframes. But I think coming back to your core point around that ambitious target, if we put it in context, we had net migration of close to 500,000 this year. Numbers are probably going to be similar next year. We've got dwelling approvals running at well below the ambitious target of $240,000. So the simple math shows that there's a big supply and demand mismatch, not only now, but coming, that could be exacerbated in the next few years.
Let's put your crystal ball on the desk. Next year, what are you seeing, Anthony, as far as, okay, let's assume that the Reserve Bank is done. They might raise again, though. What are you seeing in the property market next year? Will investors, when are they going to start to come back, do you think?
Yeah, look, I think Michele Bullock made some good points, which you've been discussing earlier in the show around, at the dinner last night, around the shift in inflation to domestic demand. And essentially where she was intimating is we got more control over that. It's going to take longer to get our inflationary numbers back to where we want them to go, and our lever is interest rates. So we can assume no interest rate rises. I think there will be another one early in the new year. That's just a personal view. In terms of the housing market, though, I think there is some suggestion that the rate of growth might ease off a little bit. We are starting to see more stock come onto the market, and new buyers are genuinely being hit by affordability. Consumer sentiment is quite low at the moment. So we're starting to see some constraints in terms of people buying, even with some extra supply in the market. That might actually slow down the rate of growth, which isn't a bad thing for the market, for people trying to get into the market. Investors, I can't see the investor challenge really going in terms of the actual cost to hold their property. A lot of investors are having some cash flow challenges. In fact, we're actually seeing a trend of the levels of investors as a percentage of total listings is quite high at the moment. It's over 30%. It generally sits at around 26, 27%. So what we're actually seeing with investors is some investors offloading properties. Investor credit flows have been low. They are growing a little bit. So I think investors are still going to be taking a fairly cautious approach. The costs of servicing the loan, the cost of getting into the market are not keeping up with rental yields. So the big challenge for investors, for existing investors, is holding the properties through this time, and for new investors is actually being able to fund getting into the market, then finding those good investment grade properties in a market that's got a genuine shortage of supply.
What are you seeing in the SME space at the moment, just in terms of those flows?
Yeah, well, I touched on consumer sentiment.
Yeah.
Juxtaposed to that is business sentiment. Business sentiment is actually quite strong. NAB's did a recent business survey, and the data that seems to be coming through is business sentiment is quite strong. The biggest challenge businesses are looking at the moment is they're foreseeing a time where they might have some challenges around employment, labour market, finding staff, but businesses have generally got quite good sentiment around where things are heading. Businesses are still investing in growth. A lot of the business flows we're seeing at the moment are around working capital and having facilities to run their businesses, with inflation running quite strong. But we are also seeing businesses looking at growing. We're looking at businesses looking at maybe merger and acquisition opportunities, as well as obviously some of the secured properties. But there's been a shift in the commercial market away from some of the office space into the logistics, into the warehousing, and into those sort of things where demand has really picked up. And there's probably been a bit of a shortage of those sort of facilities over the last couple of years.
Employment security is going to be the clincher, isn't it, really? I mean, if people start losing their jobs, then market, be it in business, in property, is going to tip. Yeah,
and part of the resilience of our economy to date has been the strength of that employment market and how tight that's been. And I think everyone's been expecting that to probably loosen up a little bit more than it has. But again, Michele Bullock made a point last night that a lot of the inflationary pressures at the moment are coming from domestic demand for goods and services. That domestic demand is being served by domestic labour, it's being served by domestic inputs, and there's a strong utilisation of labour at the moment. So there's no real strong indication that we're going to see that employment market ease up maybe as quickly as is required to help some of those inflationary pressures.